Thank you for joining me. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in some of the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. This month I'd like to discuss some of the issues I'm seeing between developed economies and emerging economies and how they play into the economic debate about inflation versus deflation pressures. As such, I'd like to discuss the areas highlighted here. There is little doubt that global equity markets continue to primarily react to global central bank liquidity injections. However, it is important to recognize that there are other forces at play that are also driving equity markets. I'm not going to go into them in this session, as I will leave them for the upcoming long-wave video release. To me, they minimally consist of 6 important drivers, shown here. The issue going forward is what potentially is going to upset this set of drivers. The most talked about concern is the length of the current business cycle expansion and the to-be-expected coming recession. I showed this chart exactly a year ago in our detailed cycle analysis in trying to pinpoint the timing. We did a number of videos specifically detailing the parameters at play. China was leading at that point the upcoming contraction, with the stronger U.S. economy just coming out of the mid-cycle phase in our assessment. Our concern then, as it is now, is how China, which has accounted for over 60% of all new global debt since the 2008 financial crisis, was going to respond to a slowing global economy. What we have witnessed with all the central bank policy easing announcements is that the reality, when we take out China and the U.S., until very recently, the money growth driving global equity markets has not actually come from them. Money growth has come from the emerging markets, especially considering the EU has been basically on hold until very recently. The traditional global growth drivers have not been driving money growth throughout 2018 and the first 3 quarters of 2019. This chart more clearly makes the point. Japan in red has been constant, while emerging markets in green have been increasing central bank security purchases on a 12-month rolling average basis. Going forward, this is going to change significantly as the Fed and ECB have now began to contribute. Note China is not included here because the People's Bank of China does not add liquidity via buying government and agency securities. We'll talk China a little later. Therefore, total central bank assets, including China, have been shrinking slightly, primarily due to the Fed's quantitative tightening, or QT. But this is about to change, and change in a significant manner, which the markets have lately been aggressively pricing in. But let's return to the emerging markets versus the developed economies for some perspective on what the future might hold for us. The economic question that continues to baffle central bank policy setters is deflationary versus inflationary forces on their respective economies as well as globally. The distortions in today's clearly excessive asset prices are highly likely going to lead at some point in time to a fix via potential dramatic systemic reset. Most generally feel this will occur either by a deflationary event, which destroys the malinvestment in the economies, or an inflationary event that destroys the currencies. The developed economies are currently most concerned with deflationary effects, since the central bank's accounting indicates that a sustained 2% inflation rate has not been achievable. Emerging markets, however, have a much different problem. Before we talk about the pressures on developed and emerging economies, let's recognize that today, developed economies are primarily service economies, while developing economies are primarily goods or industrial producing economies within highly competitive global supply chains. First, developing economies. Deflationary forces in developed economies is pressuring prices of consumer goods and thereby profits. The degree of lending leverage. Both are pressuring financial asset values downward without the infusion of massive amounts of liquidity. Deflationary pressures are coming from imports from the developing nations. The perceived solution has been and continues to be and likely will be thought to be in the future, reduce the cost of money and increase liquidity. Where that ends at zero bounds and lower is still in the future. Secondly, the developing economies. Inflationary forces in developing economies is pressuring upward labor costs from competitive currency debasement. High bond yields are weakening domestic lending, and inflationary pressures are coming from the hot money capital costs from the developed nation. That is, they're being forced to borrow to get liquidity by borrowing in foreign currencies. The perceived solution has been competitive currency debasement. We currently have self-reinforcing destructive forces at play which systemically are not self-correcting. Developed economies' deflationary problems are reinforcing emerging market currency problems by increasing hot money flows due to high levels of liquidity injections. Meanwhile, emerging market inflationary problems are reinforcing developed economies' malinvestment problems by reducing cost barriers to entry and forcing accelerated creative destruction and profit erosion. So far, I may not have told you anything you did not already know, but what happens if we see inflationary forces in the developed economies coming from service inflation? That is, education, medical, fees, taxes, professional services, which Charles Hugh Smith and I did an extensive video on, which is in the Macroanalytics archive, on the critical nature of inflation that's now coming out of service inflation. Therefore, the inflationary pressures are coming internally or will come internally. The perceived solution will be what? Will it still be reduce the cost of money and increase liquidity? Deflationary forces in developing economies, on the other hand, is coming from steady, slowing global demand. That is, quantitative easing and all the other forms of monetary malpractice has brought future demand forward. It does exactly that, which means there's a hole on the other side of that demand or a slowing. That's just built into by the nature of 10 years of these policies. And also, there's a demographic shift in spending, boomers versus the millennials. It's a massive 73 million people problem on both sides. Inflationary pressures also could come internally. The perceived solution will still be competitive currency debasement. It would entail a protracted discussion if we were to examine this list of global cross-currents in an attempt to try and ascertain what the new perceived solutions might become. Well, that actually isn't important today because you can expect the powers to be to simply do more of the same at larger levels and faster rates until something breaks, and then, and only then, will newly minted perceptions arise. A complex, globally coordinated response, which is required here, isn't likely when we can't even agree on more simplistic matters, such as trade policies between two countries. It is going to take a crisis event, which may be on the horizon over the next 5 years or sooner, and nobody can really truly tell. It'll be an event. The global economy is in trouble as real economic growth has become insufficient to absorb the massive amount of global debt payments, a massive burden on potential investment. Global trade has been steadily falling since late 2017. Over this period, the downturn has accelerated on an annual percentage basis change, even when you include the IMF's notoriously optimistic forecasts. Global trade on a year-over-year basis contracted by 1.1% in September, marking the fourth consecutive year-over-year declines and the most extended period of subdued trade since the financial crisis in 2009. This is why the IMF and the Bank of International Settlements are beating the drums about fiscal stimulus and even monetary policies such as MMT and NIRP, or negative interest rate policies on an expanded basis. The Business Condition Index tells the coming story with already plummeting PMI headlines and new orders. The IFO World Economic Climate Survey has been warning for some time and is now negative at levels approaching those of the financial crisis. Any measure you look at tells the same story. This is the gun barrel that the emerging markets have been staring down now for 18 months and actually longer. But it is no longer just the emerging markets. The slowdown is washing ashore now in America, though it is later, as we showed earlier, in the economic cycle. The economic surprises only continue to worsen as they cross the zero line. The U.S. leading economic indicators are becoming consistent in their message also, as well as industry and consumer indicators. The U.S. Economic Output Composite Index are now at levels that normally portend the entry into a recession. The recent yield curve inversion, and more importantly, and I say stress more importantly, its uninversion and steepening confirm all this from a historical perspective. This is why the Federal Reserve has so abruptly reversed policy direction. The October repo chaos is only a symptom of the economic disruptions that lie ahead. The focus now needs to be in answering, what will China do? As I mentioned earlier, China's economy over the last decade has created 60% of all new global debt. This means with China's economy in freefall and the People's Bank of China powerless, more or less, over downside, their GDP will likely fall to the 5 handle in early 2020. Most importantly, this means a global economic rebound of massive proportions is highly unlikely to happen early next year. China's central bank warned recently that downward pressure on China's economy is increasing, and it anticipated it would increase counter-cyclical adjustments to prevent further downward pressure on the economy. The People's Bank of China's annual financial stability report said that China would continue to deploy fiscal and monetary policies to support the economy, but warned economic deceleration would continue through year-end. Now the People's Bank of China is warning, according to reports recently from Reuters, that it might not be able to ward off these downside pressures in the short term. Fathom Consulting's China Momentum Indicator 2.0 provides a more in-depth view of China's economic deceleration through alternative data, as there is no evidence at the moment that would suggest a drop yet in China's economy. Policy maneuvering by the People's Bank of China will be limited, as it will likely need to cut rates and the amount of money banks put down as reserves to promote credit growth. The People's Bank of China recognizes the rapid deterioration in the economy, along with the limitations of further monetary policy to revive growth. Likely, credit creation by the People's Bank of China won't be in magnitude seen in the last 10 years, used to save the world from escalating several deflationary crashes. China's credit impulse has rolled over. The probabilities of a massive global economic rebound in the coming quarters are unlikely, as China just simply continues to slow. The government will likely stabilize its economy, or at least create a softer landing through tax cuts and infrastructure spending, and as their annual report recently outlined. What this all means is that China's economy isn't going to save the world, as it has consistently done since 2008. This is going to be left to the other developed economies. Good luck with that. The magnitude of their required response is only likely to significantly worsen the self-destructive cycle we outlined earlier. And this is the story that we need to be watching very, very closely as it begins to unfold in the first half of 2020. There are mounting pressures on U.S. equity markets, which we will explore further in our upcoming long-wave video. Meanwhile, any let-up in global money supply growth is going to be problematic. This is why any deviation, such as the one shown here, which was just reported, causes market jitters. More on that in the upcoming long-wave video. So in closing, as I always remind you, remember the answer will be to print more money. It is the only answer politicians will ever actually agree on. Until, that is, no one wants it or trusts it. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for actually investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2019 turn out to be an outstanding investment year for you and your family. I thank you for listening.